our webinar on a really exciting build to rent investment opportunity in Centerville, Ohio called Trulo Homes Stone Ridge. So we'll get kicked off here in just about half a minute. If someone out there in the chat room would just say good morning or tell me where you're from, that would be helpful. We'll make sure that you can hear me and the team out there. So drop in the chat if you can hear us and let us know where you're from. Fantastic. Thank you. Thank you. All right. Well, now that you can hear us and the chat box works, we'll get kicked off. Again, this is a webinar here. We're going to jump into an exciting investment opportunity called Trulo Homes Stone Ridge. If you have questions throughout, please drop it in the chat box. Myself and my co-presenter here will be happy to go through them. But to kick things off here, the official introduction, my name is Chris Lopez. I'm a real estate investor here in Denver. As you guys know, I've built an active portfolio, also built a brokerage and helping people go out there and buy rentals. Now, as the market has changed, the last couple of years, I've been disposing of my rentals and reinvesting it into private real estate equity deals like the deal we'll be talking about today, along with new capital. Instead of buying rentals, I'm investing in deals like this. And that's part of the reason me and the team founded Property Llama Capital, was to go out there, and as we find these deals ourselves, we can bring other investors along so we get better access to opportunities and also sometimes some better deals as well. So quick note here, general disclaimer, I'm not your CPA, not your tax advisor or anything like that. Always go out there, talk to your team. Investing is a risky activity, so always make sure you do your due diligence. And we will be sharing some numbers in here. Understand these are numbers that we have sourced between our respective companies. So always go out there and verify it. And this webinar is not an investment offering. That will come in the form of the PPM, which we're happy to send to you. But the agenda today is we'll kick off an executive summary. We'll talk about the build to rent asset class overview. Then I'm going to introduce our guest and sponsor on this project to introduce him and his background, and then talk about the market, why they picked Centerville, Ohio, talk about the project details at this 200-unit build to rent community, and then go through some special things they have set in place with their in-house property management. Then we'll go into the details of what the targeted investment returns are. So the executive summary here, the project name is called Trulo Homes Stone Ridge. It's a 200 total count of detached single-family homes. Think about this giant subdivision of 200 homes, but rather than selling them off individually, they're going to keep the entire portfolio and rent them out. It's a horizontal apartment building. So it's a good mixture of 1 bedrooms, 2 bedrooms, and 3 bedrooms. And the steel's total equity is about $20 million with a total need about $60 million. So it is a big project, which gives us some amazing ability to scale and a difference of opportunity that we can't get as solo investors. So it's planned on being about a 43-month hold. Once we go out there and start building the project and the site's completely shovel ground ready, once the money's in the bank, they will start digging the following week. Expect to be a 43-month hold, which should put us in the low 20s for an IRR, and then start getting some nice 8, 9, 10% cash on cash return starting around month 30. Minimum investment's $100,000, and capital is due by February 28th, 2025. So why I like it, love the BTR asset class, strong tailwinds, which we'll talk a lot about, has an amazing location for where the site is selected in the Dayton MSA. And as a Colorado person, Ohio is a landlord-friendly market. And they also have good conservative financing on here, which really helps to mitigate the risk. And then the general partners all have a strong track record of what they've done in real estate over the years. So talking about the build to rent asset class overview, I always like to start with like the trend is your friend, right? Anything we do out there, whether you're buying a single family home, buying an investment company, or doing a big project like this, we want to make sure there's demand there. Who's the consumer? Who's the buyer? Who's the resident in this case? And what's the demand for it? We don't go out there and buy a rental or build a property and not have someone that needs it as a place to live. Well, if you look at the macro trend, I think we all know this. The U.S. as a whole has a lack of starter homes, a lack of homes in general, and just a lot of affordability issues. There's just a ton of headwinds, and that really impacts a lot of like the younger, newer type home buyers. And this graph here just shows the percent of starter homes, or 1,400 square foot home being built. And since the 80s, it is just down, down, down every decade, and it's not getting any better. Go out there and Google it, or ask your AI chatbot, and there's tons of data about the headwinds on there. And this is exactly what the build-to-rent asset class is focused on, is providing that single family living that residents want and making it a lot more affordable. So they build these, 100, 250 house subdivisions. And then they go out there and they have one property manager, and they have all the resources there to make it great for an investor, but also very ideal to the resident. Now, you might be saying, okay, who are the people renting these communities? Really two main demographics here. One is millennials. So these are renters by choice. They are tired of living in vertical traditional apartment buildings, and they a lot of times unfortunately can't afford a home due to like no inventory or just the affordability issues. The other set are a lot of retiring baby boomers who want financial flexibility and, as they call it, lock and leave. Hey, a nice place. They don't need the 4,000 square foot McMansion anymore. Go out here, get a nice place. A lot of the stuff is taken care of. It's not senior living, but hey, when they go travel for a month or two, they can just lock and leave the apartment, or leave the home, I should say. So here are a couple pictures here. It's just, beautiful new builds. And a lot of times they have the amenities of like a Class A apartment building, the fitness studios, the pools, some gated aspects of it as well. But the benefits of a single family home with parks and dog parks and private backyards and no neighbors, above you, below you, or to the side of you. So what I like about this is I'm going to compare build to rent to single family rentals, because both residents and investors kind of get the best of both worlds, right? Residents want a lot of times that single family living, no neighbors, no one above them, a garage, a private backyard, a fenced-in backyard for their dog. That is what they're wanting, and there's not enough inventory out there for it. Now, as an investor, we love giving that to residents because, hey, if that's what they want, we want to provide that to them to go out there. That's a good, business investment decision. The problem is going out there and buying 200 scattered site single family homes across, say, a Denver metro or Ohio, or Dayton, Ohio. It's just incredibly tough. Every property is unique. Every property is with a snowflake. And you have to go out there and have different floor plans, different layouts, different maintenance issues, and it just becomes very hard to do it at scale because there's so much more cost and points of friction. Like I said, now with the build to rent community, you get that all in one community. So, hey, we're able to give the residents what they want, but enjoy the apartment style operational management. Now, comparing this to traditional apartment buildings, like I said, one of the benefits of BTR is we get that operational scale. Now, as a resident, a lot of times these residents have outgrown living in a vertical apartment building, so they get their single family home, but they get the amenities of that apartment building, of a lot of people taking care of, lawn maintenance and trash and just some gorgeous common areas. And again, as the investors, we get the operational scale of it and get to ride this new trend of essentially building horizontal apartment buildings. So I got plugged into the BTR asset class probably in like 2018 timeframe. It got on my radar, and I studied it. I'd go to like I'd see a speaker here and there around town at like a DU or some real estate conference here, and was always just intrigued and fascinated. The problem for me as an individual investor was such a scalable investment and so hot. They were going to a lot of the institutions, a lot of the groups writing 10, 20, $30 million checks to take that whole project, because essentially so much capital wanted to go in that market. It got very hard to go in there and get a seat at the table as an investor. Well, hey, I can't write a $20 million check. And so I've always been, waiting for the opportunity to go in there and be able to invest over the years. Well, last year I had the very good fortune of meeting Ryan Watts, who was one of the managing partners at Red River Development, and they've been focusing on the build-to-rent asset class for years. They're in a position to go out there where they're doing more projects. They need more investors, and creates a great opportunity for like me and other investors out here. So very glad to welcome Ryan to the webinar. Ryan, good morning. How are you?
Hey, good morning, Chris. I'm doing great. I'm doing great.
Awesome. Well, like I said, I will just started, singing your praises out here, but want to give a high level when we look at investments like this is, going out there and building a $60 million or $60 million 200-unit subdivision. Hey, that's beyond my, ability other people. And that is why, you, the sponsor, and then you're partnering with Leo Brown Group. They're the boots on the ground in Ohio. You always want to look at what the track record is, or this is what I look at as an investor. Like, hey, who are the guys behind the projects? What's their experience? What's their expertise? What's their bankroll for doing things, and have they done things? Well, Red River Development as a whole has almost 500 million AUM across their build-to-rent communities. And then their partner, Leo Brown Group, has over $1 billion in properties developed throughout real estate. Now, Ryan, there's a lot of names on here, a lot of people. Can you tell us more about who Red River is, and we'll talk about Leo Brown Group?
Yeah, of course. Happy to. Yeah, so I co-founded Red River Development in 2020, and I formed that business with two partners, Jay Dempsey and Stephen Watts. Jay has an extensive background in senior living, has a company called Civitas Senior Living that is still a large senior living operator. Stephen, who happens to be my brother, he's got a background in construction, project management, and development. And so Jay and I were invested in some of Stephen's multifamily deals in 2018, 2019. We were talking about build to rent as an asset class, talking about that as an investment opportunity. Decided, I've always been an entrepreneur. I actually sold a company in 2020. And so as we were talking about this, we said, hey, look, let's form this business to invest behind build to rent, a trend we believe in. And so we formed Red River Development to do that. Corbin Cross is our CFO, also a partner. He joined very shortly. He was the VP of Finance at Civitas. And so that kind of makes up the core of our team and our management team here. And so, fast forward to today, 480 million in AUM, about almost 1,500 units under management. We have been, 116 million of equity investment. And then we built a BTR brand called Trulo Homes, TRULO. As you said earlier, with Trulo Homes Stone Ridge, that will be our 6th build-to-rent community. Today we have active communities in, from left to right: Tulsa, Oklahoma, Oklahoma City, Kansas City, Bentonville, Arkansas, and Indianapolis. And we're fully stabilized in Tulsa. Just hit stabilization in Oklahoma City, 70% leased or so in Kansas City, and then about 35 to 40% leased in Bentonville and Whitestown. So has been a fun business to build, a product that we're passionate about, excited to be able to offer this product to our residents and give them something that we feel like really helps the housing crisis, helps with the affordability issues, which you touched on earlier. And then, we do manage all these communities ourselves. So we think that's, for us, the right way to do it, and ultimately a better way to do it for the investor as well, because, we've got better operational control, more alignment. We're aligned in the sense that we want to not just provide a great experience to the resident, but also deliver for our partners and our investors operationally. So that's the quick background on Red River and our team.
I love it, and I would definitely recommend these guys, go in there and always get to know the sponsor. Like, look at Ryan's and Steve's and Jay's background. They all have just very impressive, backgrounds of starting projects, doing real estate projects, and seeing them, full cycle through, which is something I always like to look at when I'm partnering with people on investments. Now, Ryan, who is the Leo Brown Group? Because they are a partner in this deal, and they have a very impressive background.
Yeah, for sure. No, we're excited to partner with Leo Brown on this deal. This will be our second community we've developed with Leo Brown. Indianapolis was the first one, which I touched on earlier, is about 35% leased, and we're still finishing up construction there. Jay, my partner, got to know the Leo Brown guys kind of through they were both active in the senior living space. And as mentioned here, Leo Brown has done more than $1 billion in ground up development. Most of that being seniors, but they've kind of shifted a little bit to multifamily. We shared with them early on what we were doing in with Red River and kind of our build to rent strategy, and they said, "Hey, look, we think the Upper Midwest markets like Indianapolis and kind of that Dayton, Cincinnati market and a few others that we kind of said, hey, look, these would be great markets for this product. They have developed a lot in that region, know that area very well, deep relationships and contacts to help identify and find sites, and have invested in a lot of these communities over the years. So, and then furthermore, they're also have an affiliated general contractor that builds for us up here. So really good construction expertise. They built our community in Indianapolis, and we'll be building Stone Ridge here as well. So, yeah, great partners. Have a really good relationship with them, and feel like they're an important part of the picture here when it comes to this opportunity.
Yeah, and we did a podcast here with Bill Morton on the Leo Brown team a couple months back. You guys want to learn more about Leo Brown and their, a real estate experience and their expertise in the market, we will link to that podcast. So the way I like to present these webinars is the same way I go out there and, look for opportunities myself to invest in, which is always kind of leads where, our team at Property Llama Capital goes out there to look for deals. And as I said, hey, the BTR asset class is just, I think it's the next big thing in multifamily. Hey, value was huge in the last cycle. I think BTR is going to be the big one in this next market cycle due to all the demand and very limited supply to it. So that checks the box. Second is, hey, who is the sponsor? Who is the jockey according to the project? Well, Ryan and his partners and the Leo Brown group, they are experienced jockeys. It's not their first race. So the next thing comes down to is, what does the market look like? All right, opportunity looks good from the macro trends. Sponsor looks good. All right, where are they doing this project? Does that local market support what the bigger trend is? Because we all know location is vital when it comes to it. So this project is in Centerville, Ohio, which is, you can see it right here. I've got it on the Google Maps here. It's this little red dot here. So it's south of Dayton, west of Columbus, east of Indianapolis, north of Cincinnati. So it's in a very strong, or a great location, surrounded by some of the bigger cities in the Midwest. Now, going back a slide here, Red River is often a first mover in some of these up and coming markets, where, hey, they identify these areas and they have a very good track record on those past projects. They're not throwing darts. They're not getting lucky. It's the fact that they have a very data-driven approach. And this is actually one of my favorite slides here, because I think, the importance of site selection is just vital, Ryan. Could you talk about kind of like the national benchmarks you guys are looking for, and then how that filters down to the site selections and how that's been favorable in the past projects?
Yeah, of course. Once we settle on a market, in this case, kind of the Dayton, Cincinnati market, and just starting there, a lot of confidence in that area, given Leo Brown's track record of development in that market, understanding of that market. We felt like, that Dayton, Cincinnati market, a 3 million person MSA, with some really good fundamentals. And you've seen it even today. Midwest is really having a moment here where it sits in, by a lot of measures, in that top five rent growth market in the U.S. So love the Cincinnati Dayton MSA. Then it comes down to, okay, where do you want to go? And we use a data-driven approach. We're focused on some key demographic factors, which you can see here when we think about site selection and kind of our investment criteria. And so you can see all of our projects on the left stacked up against the national benchmarks for these various metrics. So As you can see here, Stone Ridge compares very favorably to our other projects. Is certainly in line, and then is exceeding most of the national benchmarks there that we would look at. And one thing that jumps out here is you do really the highest median incomes in this community of any project we've developed to date. So we think that's a great thing when it comes to being able to hit target rents and maybe even push up beyond that on this community. So those are my thoughts on just the overall investment criteria and our demographics.
Yeah, this is great. And so, thanks for covering that, Ryan. And I, recommend everyone go out there and, look at these because, hey, as investors, all we can look at is, hey, what's the trend here? What's number here? What's this? And, hey, all these check off just important, growth metrics or rent income ratio points. So dig through this, but I like the approach. And that is how they ended up in Centerville, Ohio. And this is a closer, just zoomed in map. So you can see the green box here, Trula Homes, is right around where the site will be. 20 minutes to downtown Dayton, 45 minutes to Cincinnati, Ohio, right there off a couple of freeways. So just a prime location in a growing MSA. Now, markets really need two things, Ryan. They need people and they need jobs. I'm never quite sure which one comes first. I think it depends on the area, but like you need both. And from a high level, if I could only look at things, I'd be like, hey, what's the job base and what's the population base? And I think that is the most important metric out there. What's the employer base like in the Dayton area?
Yeah, it's strong. It's strong, as you can see reflected here on this slide. Wright-Patterson stands out as the largest employer, one of the largest Air Force bases in the country. Right there in Dayton, probably 15 minutes or so from this site. So we think, for a lot of the maybe higher ranking officers, this could be a great community for them. Both Cincinnati and Dayton have strong universities, University of Cincinnati, University of Dayton. Those are great employers and great, economic drivers, big healthcare systems, and then some large kind of corporate headquarters, where you look at Kroger, P&G, folks like that. Overall, a really strong employer base, and feel good about the overall market here.
Yeah. And then, this is just an view of the demographics. Already touched on that with that matrix a few slides back. So you can go back and revisit that. But here's another important thing to look at when you look at, the local market is just, it is simply supply and demand, right? Hey, how many new units are being built? Because if there's a lot of supply, well, that usually means high vacancy and then slow to maybe negative rent growth. And also the inverse is true. Well, you can see here, the submarket of the Centerville Kettering has experienced consistent and robust rent growth while maintaining full occupancy. So you can see very low supply and very healthy rent growth in the 4 upwards to 8% range. And there is really no inventory in the submarket currently. So that's going to help along our project as it goes out there and gets leased up next year. This is a great slide. I won't read line by line, but just hyper focused on the submarket here of the Dayton MSA of, hey, that affordability issue of starter homes. And, one of the great things here that, Red River and Build to Rent Communities does is provides the new, safe, affordable housing. And in this market, this is right around a 22% a month savings, plus the down payment savings of, a 5 to 20% down payment. So significant savings there to consumer, not just on down payment, but the ongoing cost. And again, if they're buying a house, a lot of times they're not buying a 2025 house. They're buying a resale from, 60s, 70s, or 80s. So there's a lot more deferred maintenance, depending on when it's built. But this is just another indicator that the MSA or the Dayton area is really ripe for a product like Stone Ridge. Now, this is something I always look at now as a Colorado investor. Really was on my radar until I think everyone on this podcast, most parts in Colorado, 2 or 3 years ago, we started getting a lot of laws passed through that made it just very tough as landlords to operate out here and stay compliant. So now, like, looking at the legislative front of states is one of my due diligence check items now. And Ohio is, I would say, a much more landlord friendly than Colorado is now, and generally considered a much more landlord friendly state. Just, I think it has a right balance of always protecting residents' rights, but also protecting, landlords and property rights. In addition to, like, as we go in this new market cycle where, hey, Denver and Springs and Nashville and Austin and, Salt Lake City, we had some of these massive growth waves. Our growth waves are over. Hey, where's going to be the next up and coming market? Where are the next areas that are growing? And a lot of these submarkets, like the Dayton MSAs and areas like that, a lot of them are going to experience growth. Why? Well, one's affordability. And hey, people need a place they can afford to live. A second thing, unfortunately, is you look at, like, the California wildfires recently, like, that's displacing a lot of people. That's a big trend happening in expensive areas, which will drive people to other areas. And also a lot of companies, I've been reading a lot of headlines, companies live in California, companies living in other states, and they are seeking states that are more affordable and also more business friendly. And Ohio checks those boxes as well as another favorable indicator for the market we're in. Now, Ryan, jumping into the details of the project. So, as again, going down, you got my due diligence checklist. Now I look at properties, say the opportunity makes sense, the sponsor makes sense, the submarket in Centerville makes sense. Now we got to get down to actually, like, the sticks we're putting up and the buildings we're putting up here. So, jumping into details here, can you give us an overview of what the build-to-rent community will look like?
Yeah, of course. So this is a 200 home community, gated community. We have a mix of 1, 2, and 3 bedroom homes here. About 80% 2s and 3s, roughly. As you can see here, average rent per unit $2,400 a month, roughly. So yeah, and this is very in terms of the construction period, consistent here. About 14 months till we deliver the first phase. And our lease up really kicks off, and that's the clubhouse and maybe the first 20 or so homes. And then we'd look to finish construction around month 24. Hope to hit stabilization around month 30. So, yeah, that's a good overview.
Yeah. And then here is just, a site overview of the roads. And you can pull up West Social Road here. And then I know it's hard to see on this, but down here in the lower right where this gray box is, this shows a build to sale, so an established community, but these are $400,000 to $600,000 priced homes. So they're building, as Ryan has said, in a very affluent location, and they're building a really great product, but they're on the less expensive side. So hey, not the nicest house in the neighborhood, but hey, a good house in a great neighborhood, that type of mindset where they've got a great location. And Ryan, if I recall, I think it was this project you're telling me about. I think this used to be zoned maybe light industrial or something previously. And I know, I think these neighbors were not thrilled about having a 3, 4, 5-story building put up next to them. Can you remind me and tell the audience what that details were?
Yeah, of course. When we were working with the city here, it was actually zoned for multifamily, but the neighbors surrounding had put up a lot of resistance to the idea of having multi-story apartments on this site, given the high-end homes to the south here, and there's $1 million homes to the west, just very immediately to the west here. This is a well-trafficked road. In fact, they're widening Social Road, which is the east-west thoroughfare here, which is our northern boundary. So, yeah, by going to the city and the surrounding community and saying, hey, look, we want to build something that is going to be more residential, single-story product. It'll look like a neighborhood and probably blend in it in a different way, where you're not going to have people on the second and third story looking down in your backyard, like you would have with a high-rise multifamily community. And ultimately that, I think, resonated with the neighbors and with the city. And so, yeah, no, we love this site, high-end suburban market, just very close to I-75, which is a 5-minute drive to the west here, which is the main kind of north-south thoroughfare that connects Dayton and Cincinnati. And you've really seen a lot of development and growth along that corridor. So, overall, I think this is a great site, and we're excited about it.
Great. Let me get my screen working again here. And then these are just some renderings of, the 1-bedroom, 2-bedroom, 3-bedroom units here of, just seeing some different floor plans out here for the property. And it's something that, is worth highlighting. And we've shared a lot of these, the track record with Red River in the past here is that, when you guys go out there and build a community, Ryan, how similar or how different is the next community from the previous ones? Is it a brand new plan, or do you get better with each community you build?
We're building a very similar product here because we think it's one that fits a lot of the demand drivers that we talked about, and we've seen it perform very well. So, every municipality is unique, every site is a little bit unique, but the product type is consistent across all of our communities, and this is very similar to what we built in Indianapolis, which is about an hour and 40 minutes west of here. Again, and Leo Brown building that community. So we feel like this, is very consistent with what we've done before, and certainly we've gotten better over time, I think, but both at building and developing these types of communities and, managing them and leasing them up. So yeah, that experience, does start to pay dividends.
And then, here's a screenshot of the project budget. And, we won't go through this on today's webinar, but our plan is to do a separate video on here, just doing a much more deep dive in here. A, because a lot of people are interested in how development works, but also B, let's go out there to understand the numbers behind it. And then, Ryan, I know you guys have, I think, 2 term sheets from banks, and they look very similar. And so you displayed them here, but which one did you go with, or any commentary on the bank debt here?
Yeah, 2 good banks here, large regional banks. Both of these are banks that are us as a GP group have worked with before, so good relationships there. The sponsors are personally guaranteeing these loans, which really help us get, I think, the most competitive debt financing rates with a kind of a SOFR, both banks at a SOFR plus 300 rate. So the way it's looking right now, we've gotten term sheets. We've been approved with the loan committee at both banks. I think there's actually a good chance that these banks will both participate together, and we'll kind of share the loan. And so that's the way this is taking shape here with the banks.
Yeah. And I'll highlight a few things on here that jump out to me. Again, 65%. I think that's a healthy loan to cost. Again, I love leverage as a real estate investor, but too much leverage can be a bad thing. That 65% is a really good risk reward adjusted amount. And then, as Ryan said, they are personally guaranteeing this as well. So that just means is hey, besides getting better terms, these guys have a lot more skin in the game than any of us do when it comes to investing. And so I always like that alignment on there. So here is the operation summary of the property, assuming that, hey, once lease up starts at the end of this year timeframe, you can go through here. And again, as we go in there and do a video on deeper underwriting, we'll go through and break this down, but just want to share it in this draft of the webinar. Download this and review it on your own. And then here are just some, market comps of what's going around the market. And so you can dig in that data because I really want to get to this slide here. And this goes along, to rewind it a few steps with the, demand, the high demand and limited supply out there. And Ryan, I know on your previous projects, you guys have achieved some pretty successful double-digit rent premiums. And on average from the floor, I think you guys have achieved about a 20% rent premium, right?
Yeah, that's right. That's right. So we kind of show this in two ways. On the left, you see it shown on a per square foot basis, where we're about 33%. We have about a 33% premium over, Class A new built multifamily. Our Trulo Homes communities achieve that premium, and then on a chunk rent basis, which is just hey, what's your all in monthly rent? About a 20% premium. So I think what that shows is that residents value the product here and value what we're offering, right? And they're willing to pay a premium over that multifamily suburban multifamily competitor in order to get the private backyard and to really get a home versus an apartment. So.
And so what I like to see as well is this as a 1, 2, 3 bedroom. They're all right around that 20%. So it's not just, hey, one of these is what's pulling up the average. They're all right around that 20% premium, which is a great thing to see. And what we want to see as landlords, right? So something else, and I always view property management like, myself include, many investors want to self-manage. They hate third-party property management. It's a very necessary evil a lot of times where it can be really tough to go out there and operate it. And something that, seasoned investors really understand and appreciate is, hey, look at all these buy-side numbers, all these analyses. Hey, look at year 3, pro formas on the operating statements. And so much of that success really comes down to just having great property management in place. And a lot of the most successful groups I have seen and projects I have invested in over the years, the majority of them have all had in-house or vertically integrated property management. Now, Ryan, can you tell us who Trulo Homes is and how that relates to Red River Development?
Yeah, of course. So Trulo Homes is the brand that we created, and it's how we have positioned our build-to-rent communities to the market, and it's also how we refer to our property management business. So again, we manage all these communities ourselves. They're all called Trulo Homes communities, and we think there's and I touched on some of this earlier, but the benefit there I think really is alignment with our partners. We're very focused on delivering a great experience for the resident and making a Trulo Homes community a great place to live and a place that people want to stay at and want to renew at high rates. And we see that. I mean, one of the big benefits of build to rent and these Trulo Homes communities specifically is that we see renewals at about 65%, whereas you're probably in the low 50s with a traditional apartment community. And our tenants, they tend to stay, probably twice as long as the average stay in a apartment community. So we think that's, partly because of the experience we're providing. And then, coming back to performance, we want to be mindful that we're operating these things with the right operating margin, that we're managing expenses, that we're leasing it up as fast as we can. And so we think by controlling that property management function, we're doing a good job for our investors and our partners here too with that.
So kind of wrapping up the presentation here and moving on to the investment returns in our overview webinar of the Trulo Homes Stone Ridge project. Again, this is the same screenshot of the executive summary that we had at the beginning of the slide. So wanted to jump into the detailed structure. We are projecting to exit this at about a 5.25 cap rate at about month 43. So about 4 years out, 3.5, 4 years out, exiting there at a 5.25 cap rate. And you can see here that the untrended yield on cost, that's really, hey, building and performance today, kind of like development cap rate version, is, about a 7.1%. We want to see that higher because the bigger the difference on there, either the more profit we make. So that's a nice spread there. And of course, the market conditions, we may see cap rates compress as well as we're selling into, a strong recovery market. Now, overall, the bulk of the return will come when the property is disposed at the end of this investment, with some cash flow along the way, maybe starting around year 2.5. But the bulk of the return will be when it's sold. And we've taken the cash flow and the return. We are estimating a 22% IRR with upside. Now, this is a 506C investment. So that means you have to be an accredited investor to invest in here. Minimum investment's $100,000, and the capital is due at the end of the month. Now, the fees on there, we have set up a special purpose vehicle, or SPV, to go out there so we can pool and bundle our investors together and then invest in the Red River together as one check. As I said earlier, build to rent's a very, hot investment class. So we pull our money together to get access to it and also get better terms. So there's a 2% upfront due diligence fee, an annual 0.5% fund management, so very, very low. And then just some basic admin costs to set up the legal, accounting, and basic entity setup. And then at that level, it's an 8% preferred return followed by a 90-10 split. Now, of course, this will all be laid out in the PPM that we're able to share with everyone. But I want to move on to this table here. And this is a sensitivity analysis of what we could expect in terms of potential, total IRR. And you can see right here, it is modeled at that 5.25, like we talked about, and then a 7.2% rent premium. So on the conservative side here for rent premium, and that comes out to, a 20.8 IRR. Now, hey, if rent premiums stay the same, but we're able to get a slightly better cap rate, hey, from 5.25 to 5, we're going to jump up about 2 points to 22.7 IRR. So, modeling a low to mid 20s IRR, definitely with some upside, with strong tailwinds of hitting, premium rent, and also potentially seeing cap rates compress when it comes time to sell a few years down the road. So low 20 IR with upside is the way I view it. Now, a question that we often get as we do deals like this with, Red River and other groups is, hey, will I get a better return by investing directly with Red River? And in this case, no, you will not get better returns. If you're stroking, a $500,000 check, hey, let's talk. But really, I want to kind of take a step back and let people understand this, because this confused me when I started investing years ago in the position, like, well, hey, why can't I invest directly? Well, look, this total project is $60 million is what it takes to go out there and build everything, right? Between debt and equity, that's what they need to go out there and fund the project. So they need about $20 million worth of equity. So they have a big RIA, registered investment advisor firm. They're the anchor investor. He's going to take up $10 to $12 million. They're going to do GP co-invest somewhere in the $750 million range. And then they're working with capital groups like Property Llama to go out there. We're going to bring $1 million to $2 million each to go out there and contribute to the capital stack. But by bringing, a 7-figure check, we get some discounts, will actually give us better economics than investing directly. And the reason here is for a lot of big groups like Red River, their area of specialty is building these projects. They don't have the area of expertise to go out there and scale up a whole fundraising campaign, especially to like a lot of, individual investors like we have. So this is a very common structure in the world of real estate private equity, where it's a win for the sponsor. They get, capital groups like Property Llama Capital bring in, 7-figure checks to their deal. The capital groups are able to get better economics by bundling checks. And then that goes back to the LPs, where they can go out there and get access to the deal, but actually get slightly better economics as well than investing directly with Red River. So if you guys want to go through some more detail, always let us know. We're happy to walk you through there. But that is the high level of what the investment terms will look like, and why, Property Llama Capital is putting together their own SPV, or a fund of funds to go out there and bundle investors and invest in a deal like this. Now, I'm investing in this deal, alongside everyone else in the SPV and in this deal. So, I believe in it. We got some team members as well. So, hey, the GP, the Leo Brown Group and River, they're putting some of their money. And at our level as well, we're putting in money as well because we love the deal and are excited to get access to it. A common question we get is, will you receive depreciation? Yes, you will. But it's development. You won't receive it in 2025. It'll start in 2026 as units are built out. And so Red River will have some updated depreciation schedules out, very soon as far as what we can estimate. This is a project from one of their Oklahoma BTR developments. We can see, how much more the cost segregation's got on there. The thing is, a lot of the bonus depreciation has been phasing out, but with the new administration coming in, a lot of the chatter is that, depreciation and the real estate tax benefits they passed last time, they want to come back in there and, grandfather them in or reenact them as well. So we're hoping to see what comes out of that and hopefully see some favorable legislation that will give us more tax advantages with real estate investing. Now, as far as next steps, we always want people to go out there and review the details. Our goal here is always to provide exceptional deals while also giving transparency and the ability of doing due diligence. A lot of people invested in 2018, 2019, 2020, 2021 deals. Quite a few are getting burned now from between market cycle stuff and also just pure due diligence and poor transparency. And so we're all about, hey, let's find great deals, but let's go out there and get you all the access so you can do due diligence, but also go out there and be able to actually meet the sponsor, who's the person who's ultimately, putting the money to work and run the project. So please review the details, and then you can go to this website here. And this is a form that will reserve your spot on the interested investment amount you have. We have a $1.5 million allocation with Red River. We expect that to fill up. If we do, we might be able to get more. Just depends on how the other capital stack fills out. But we don't have 1.5 million with them. So go in there, reserve your spot. It is not, you're not contractually guaranteeing it, but it's just reserving a spot. But what that does is allows you to get all the legal docs to be sent to you. That's how the system works. So they can review the full legal docs, which is the investment offering on there, and take a look at those. And after you get a chance to review all the details, would love to have you guys set up a time to actually meet with Ryan, over a 20-minute Zoom call, or if you happen to be in town or you're down in Texas, sync up for a few minutes. I always love meeting, the sponsors of the group. And one of the things that our goal here at Private Development Capital is to not just find great deals, but allow you to actually get to meet the sponsors as well. So once you get to meet with Ryan, get any final questions answered, sign the docs, and then send your wire in before February 28th, as that is the capital call. And one last thing I'll say on here as we wrap up is, one of the reasons I really like about this development is that, hey, when the money gets in the door and they have all the capital in there, the project is shovel ready, meaning that they don't have to go out there and spend a year or 2 years to work with the county and rezone, or go out there and do a bunch of pre-development work. No, it's ready to go. They just need all the capital so they can start the vertical building of, putting shovels in the ground and building. So what that does in development deals like this, it greatly de-risk it because we're coming when things are ready. Everything's approved, ready to go. And then secondly, it allows us to, kick things off and have a shorter timeline because, hey, a lot of times the shorter the timeline, the higher the return or IRR we are making. Couple questions in here about where are the other documents available. We have a data room. They'll have all this stuff on here with links to podcasts, link to the slide deck, some additional information as well. And then we are going to be doing some future questions and answers and some of those deep dives in the underwriting. We'll put everything there. I don't have that link handy. I don't know if Jules or else, if you guys do, can drop in the chat or we'll email it out afterwards. I just don't have that window open on my tab. But if we don't drop it here, we'll definitely send an email with this recording and then the data room, which is where everything goes. So you guys have questions, start dropping in the chat box here. We'll do a minute or two of Q&A. But Ryan, I really appreciate you taking the time to come out today to present to us, to talk to us. But overall, I am just really excited about the opportunity and this deal you guys have in Centerville, Ohio. I'm a big fan of it for all the reasons we just talked about. So I'm excited to invest as an investor, man.
Yeah, no, it's great to be with you, and we're excited to have Property Llama Capital as a partner here. You guys have been great to work with, and we're excited to do this project and develop this great True Homes community, our sixth True Homes community, and feel like there's more to come. So excited about that.
Yeah. Like I said, we'll be doing some more deep dives on here with doing some underwriting, depreciation schedules. We like to do that separately, so that way we can do a deep dive on spreadsheets. This webinar is for overview and kind of get the lay of the land and everything. As you go through this, if you guys have any questions, reach out to us. Like I said, our goal is to always be provide great deals, but provide transparency and making sure you understand everything about the deal. That's something we're very proud of here, and something we're excited about Red River is they always have the answer, and we'll show, hey, here's what's going on, and here are the opportunities. Here's why you like it. If you guys have any questions, reach out. Go to that form to just reserve your spot and get the legal docs sent to you. And then we will send out this recording along with the data room, which have all the information out here very soon. So everyone, thanks for coming out. And Ryan, thank you, man. Have a great day.
Hey, thanks a lot. I appreciate it, Chris.
Bye, everyone.